The global financial crisis gave building materials companies a pounding, but some parts of the sector are staging mild rebounds. To help us construct a clearer picture, we have Morningstar Head of Equities, Andrew Doherty. Andrew, welcome.
Okay, Vicky.
Andrew, economic signals have been encouraging of late. Where are we at in the business cycle?
Well, Vicky, we are close to the bottom. We expect GDP to range from slightly negative to slightly positive each quarter over this calendar year. But there should be some improvement through next year, supported by government stimulus, low interest rates, and also ongoing resources activity. But really, it won't be smooth sailing because, of course, we have rising unemployment that we expect over the next 12 months or so, and then probably through the middle of next year, we'll have rising interest rates to contend with.
And where does the building materials sector stand in all of this?
Well, building is a drag on the economy, and the upcoming reporting season will evidence the weak activity that we're seeing. We're expecting actually for the sector average earnings to decline by 26% for each of the stocks in the sector. And we've seen data out this week showing that work done has declined by 5% over the year to March. But we have earlier seen a leading indicator, which is housing starts, which are down by 23% in the year to March. So we're actually expecting activity to decline in the final quarter of the financial year 2009. But there is light on the horizon provided by housing finance numbers, which really have grown dramatically in the last few months. And this does lead to confidence that there should be the beginnings of a recovery towards the end of this calendar year. And so we are expecting some recovery towards the end of the year with some further pickup through next year.
What about commercial construction?
Well, commercial construction has more of a subdued outlook. Really, private sector investment is declining due to a decline in confidence and more limited access to capital. But this is offset somewhat by the potential rise in infrastructure spend by the government in ports, rail and roads. But there is an interesting contrast that we can see in this downturn compared to downturns in the past, and that is that prices have actually improved in many segments. So you normally expect in a decline for companies in this sector to try and maintain their volumes by cutting prices. But there's been an awful lot of consolidation over the last 10 years, and this means that many companies have very strong market shares in their regions or in their product groupings, and this gives them some pricing power. And so this pricing power, along with cost cuts and efficiency gains that have been pushed through over the last 18 months, really position many companies to really grow their margins quite substantially once conditions do recover.
And how big an impact is the First Homeowners Grant having on residential construction activity?
Yeah, the First Homeowners Grant and the First Homeowners Boost, along with the cash handouts by the government and low interest rates, have really been instrumental in the recent rise in confidence numbers amongst consumers and businesses. So the first homeowners really are the major driver behind the latest rebound in the housing finance numbers. But of course we want the recovery to be sustainable, and there is some confidence provided by the recent rise in investor activity as well as upgraders, and we need both of those segments to really keep going for this recovery to be sustainable.
Turning to the stock market, building materials companies have been posting some pretty respectable gains lately. Why is that?
Well, I think there's really been a strong market recovery since March, and that's really been based around companies with cyclical earnings, which are, obviously those earnings we're looking for those earnings to recover quite strongly over the next couple of years. So the market recovery really has been based around cyclical businesses, and that's opposed to the more defensive plays.
Andrew, are there any standouts in the sector?
Well, investors should know that these aren't necessarily recommendations at current prices, but people should look to our website to see our latest view. But one standout is definitely Adelaide Brighton, and this is a company with very strong market shares in cement and lime products, with a focus really on the resources states, being Western Australia, South Australia and Queensland. It has some long-term contracts in place which help smooth revenues. They've pushed through price increases lately which have helped their revenues. And really the margins are holding up well despite the volume declines. And this is largely to do with their policy of supplementing their own production with imports during periods of strong demand.
But James Hardie seems to be lagging the other companies. It just can't seem to get up any momentum. Any special reason for this, Andrew?
But the share price has really been fairly flat of late. It hasn't really recovered like many of the other building materials stocks has. And I think this is to do with, well, the asbestos liability is a drag on sentiment, but also really the main thing is that most of their earnings are exposed to the US economy. So 85% of earnings are in the US market, and of course the property market there really is in the doldrums. So housing starts are actually a quarter of where they were 3 years ago, and there really isn't much hope for a rapid improvement there because of the high and increasing unemployment rates there, and also high inventory levels in that market. Yes, Boral is another business that operates in the US. It has a brick and roof tile business in the US, and we're expecting losses of $120 million in this financial year, or the year ending June 2009. In contrast, James Hardie is maintaining strong profits, although they are a little bit lower than where they have been in the last few years.
Is it time for retail investors to revisit building materials companies, and why or why not?
We'd be cautious right now. Most companies in the sector are fully priced after a strong rally in the market that has favoured cyclical businesses over defensives. And after all, these are cyclical businesses. Their earnings are volatile from year to year. That's because their revenues are cyclical, and by and large, the cost structures are fairly fixed. And so for this reason, timing is important, and also the price paid is critical. And it's important that investors don't allow their portfolios to become too heavily weighted in these kinds of businesses, because they don't tend to be very reliable investment performers over time. Having said that, we do see opportunities for investment over the next 6 to 12 months as the market looks to the recovery through 2010 and a stronger 2011. There'll be swings in sentiment from euphoria as conditions look to be improving to disappointment as reality doesn't meet with expectations. So these downturns will provide great opportunities for buyers.
Andrew, thank you for joining us today.
Thank you, Vicky.